Welcome to Stock Investment Analysis. Today we are comparing two major energy companies, Chevron versus Exxon. I hope you enjoy this video and learn more about investing through it. In this video, my fellow investor Adriana returns to help us break these companies down.
Hello guys, first Ben, thank you for inviting me again to your channel. For any of you guys that may not know who I am, I'm a real estate agent and I've been investing in the stock market since 2017 and decided to create my YouTube channel, wanting to share with you guys my passion for investment.
Check out Adriana's channel at Adriana Gorin and subscribe. She has excellent videos on investing and I always enjoy watching them and I've learned a lot from her. In this video, Adriana will start off and compare Chevron and Exxon in terms of their business model and structure, valuation, financials, and issues of risk and debt. I will then analyze both companies in terms of dividends and growth. At the end, we'll give you our opinions about investment in these companies, so make sure you stay until the end. Let's get started.
First, I wanted to compare their businesses and then we are going to my computer to analyze their financials. We all know that the oil sector has been hit really hard because of the pandemic since no one is cruising and traveling as we used to. Also, since the whole world was shut down, people were not even commuting to their jobs. All this led to companies having to keep and store a lot of oil barrels, causing a decrease in storage capacity. Then, the market running out of storage capacity led to an increase in storage prices. Both companies, Exxon and Chevron, are integrated oil and gas companies since they find, produce, refine, and distribute crude oil and natural gas. Also manufacture, trade, transport, and sell crude oil, natural gas, petrochemical, petroleum products, and more. Okay, so for their financials, what I'm going to do is analyze it with you guys, and I'm going to put points here in what I think it's better each company. For example, here in Exxon has a current market cap of $195 billion, while Chevron $189 billion. Their PE ratio for Exxon is 17.7, while Chevron is 44.96. The thing here is that the 5-year average PE ratio for Exxon is 23, while for Chevron is 33, which means that Exxon has a PE discount of 24.10%, while Chevron is not in a discount, but is way higher than its 5-year average PE by 35%. So in here, it wins ExxonMobil. Then in the next one, the stock price currently is at $47 for Exxon and $92 for Chevron. Its 52-week high is $77 for Exxon and $127 for Chevron. So if we take into consideration their stock discount, Exxon wins again since it's down 39.47% from its highest point, while Chevron is only 27.25%. So another point for Chevron. Then for the revenue, Exxon has a revenue of $55 billion, while Chevron $29 billion. But the thing is that in comparison to their last year quarter one revenue, we can see that Exxon only decreased 10.60%, while Chevron 13.11%. I would give the point to Exxon again. For the profit margin, you can see that Exxon wins since they have 4.5% in profits, while Chevron 2.86%. Now, on their balance sheet, we can see that Exxon has $11.41 billion in cash and cash equivalents, while Chevron to $8.54 billion. That is an increase of 269% in comparison to December of 2019, while for Chevron is only 48.50%. But Exxon has a current assets of 50.25 and current liabilities of 64.77, and they have a current ratio, which is the division of current assets by current liabilities, and that gives us a total of 0.78, while for Chevron they had a current assets of $28 billion and current liabilities of 28.24, so their current ratio is 1.01. In here, we can see that it definitely wins Chevron since the higher the ratio, the better. And also, even though it's not within my boundaries, because a very good current ratio is between 1.2 and 2, and everything above 2 is way better. But still, we can give the point here to Chevron. Then, the Exxon has a total asset of $355.8 billion and total liabilities of $167 billion. And that gives us a total debt to asset ratio, which you calculated by dividing the total liabilities by the total assets, and that gives us 0.47. while for Chevron, we have a total debt to asset ratio of 0.39. So here we could give this point to Chevron again, since in difference to the current ratio, the total debt to asset ratio, the lowest the better, since it means that they have 39% of their total assets financed with debt. Now, under free cash flow, we can see that Exxon had way less free cash flow than Chevron, even though their revenue was higher. And because of that, I will give the point to Chevron as well. Then on the issuance of debt, we can see that Exxon increased their debt by $14 billion, while Chevron only by $9 billion. That goes to Chevron. In here, I'm not going to put any points since these is what analysts are expecting, but I wanted to share with you guys. So analysts are expecting for Exxon to have a decrease of 45.50% for Q2 of 2020, while for Chevron 45.70%, so it's almost the same. Then on the revenue change for the whole year 2020, analysts are expecting Exxon to have a decrease of 28% and for Chevron 31.80%. Under earnings, well, not earnings, losses, they're expecting for both companies to have a loss under Q2 2020 as well of the whole year 2020. So let's go and see what Ben has to say about these companies, and then I'll give you guys my conclusion on which one I would buy, even though one has more points than the other one, but let's see.
Next, we'll talk about dividends. We're looking at data taken from Fidelity.com on Chevron's dividends. You can see here that the dividend yield is a 5.59%, and the dividends have been growing at an increasing rate over the past 4 years, with a raise of over 8% in 2020. That's a good growth rate for a company with such a high yield. Now look at the dividend payout ratio. This shows us how much of the company's earnings are available for dividends. For the previous trailing 12 months, they only paid out 66% of their earnings in dividends. For a company like Chevron, that's a pretty reasonable number. However, for the current trailing, the number is 252%. In other words, the earnings do not currently cover the dividend. This is because the earnings dropped precipitously during the current economic crisis. This will always raise some concerns about whether the company can continue to sustain the dividend. Across the last 5 years, Chevron grew its dividend almost 4%. The last year raise was 8.4%. Now let's compare this to Exxon's dividends. Their yield is significantly higher at 7.38%, but their growth is far lower and they have not raised it in 2020. Their previous 12-month payout ratio was higher than Chevron's, meaning that they had less ability to grow it. Currently, their dividend payout ratio is also over 100%. This again raises concerns about their ability to maintain their dividend. We will return to this topic of a potential dividend cut in just a moment, but first, let's look at their dividend history in more detail. Exxon grew the dividend by around 3.5% over the last 5 years and did not raise the dividend at all this year. We were looking at dividends and overall performance on fast graphs between the two. You can see the compound annual growth rate for Chevron's dividends has been 7.1% for the last 19 years. During that period, Chevron paid out almost $21,000 in dividends. If you had invested in 2001, your yield on cost would now be 21.5%. By comparison, across the last 19 years, Exxon has had a similar rate of 7.4%, but their dividends have only paid out about $18,625.85. Yield on cost for this would have only been 13% if you had invested in 2001. The biggest note of comparison here, however, is not the dividends in isolation, but total returns. Chevron grew at 7.8%, annually beating the S&P 500 for the same time period. Exxon only grew at 3.2%, less than half of Chevron's returns. If you had invested in Exxon, you would have barely beaten inflation. Before we go further into growth, I want to talk about the ability of each company to continue to pay their dividends. We're looking at a chart from FastGraph showing Chevron's free cash flow. I know there's a lot of lines, colors, and numbers here, but what I want you to focus on is the dark green region. That is their free cash flow. You can see that throughout 2020, free cash flows decreased considerably. This point here is where we are today, so you can see it is expected to continue to drop. The free cash flow is expected to rebound by 110% in 2021 and decrease by 7% in 2022. So why does this matter? Free cash flow is what dividends are paid out of. This white line here are the dividends. Right now, the free cash flow is just beginning to go below the dividend payout. For the next few years, the free cash flow will not cover the dividends. This means that the dividend will need to be partially paid for with the free cash flow that they do have and partially paid for by cash reserves or debt. This does not guarantee a dividend cut. If you look at 2013 to 2016, they had zero free cash flow, and yet they have never cut or suspended their dividend at any time on this chart since 2000. This will put some strain on the dividend, however. Looking at Exxon, it looks far worse. The free cash flow stopped covering the dividend way back in early 2019, well before the current health and economic global crisis. The free cash flow has dropped far more than for Chevron and is essentially going to zero based on analyst predictions. While Chevron's free cash flow is a little short of that dividend, Exxon's is far more so. There will be significant strain on their ability to pay their dividends over the next few years, and some analysts are expecting a fourth quarter cut this year. Next, let me show you what the company growth has historically looked like. This is macro trends data for Exxon from 2008 to 2020. Please note the book value has grown, which means that they have been increasing their assets since that time. However, their sales, earnings, free cash flow, and gross profit have progressively dropped. None of these look healthy even prior to the current crisis. EBITDA looks at earnings before interest, taxes, depreciation, and amortization and looks similar. Obviously, we want companies which are growing and making more money over time. That is not Exxon. I am now going to compare Exxon's growth to Chevron's. When I compare these, take a look at the numbers along the sides to better understand why I am saying one is better than the other. While Chevron has been decreasing over time, it has been doing better along nearly every metric than Exxon. Exxon looks better in terms of earnings. However, Chevron's sales numbers are better, their free cash flow is better, Chevron's gross profit is better, their EBITDA is better, and their book value per share is better. What makes it even more surprising that Chevron is performing better in nearly all metrics is Chevron is a smaller company, and smaller companies are often disadvantaged. Fidelity provides data by S&P Global Market Intelligence, which shows Chevron's growth stability is above average and at a 67 out of 100. The quality is ranked even higher at an 83. For Exxon, by contrast, they consider the growth stability to be below average at only a 33, and quality is average at a 52. Finbox is a great tool I use for many purposes. Here I have created a chart on Finbox in which I compare Exxon's and Chevron's current prices to analyst predictions. The pink at the end is the current share price for each company. For Exxon, the analyst price target median is below the current price. The mean price target is slightly above. The Ben Graham number and Finbox fair value estimate put it around $58, which is a fair increase from the current share price around $48. For Chevron, the current stock price is below all estimates. There is more consistency in the expectation that the share price will increase. Chevron is currently around $93, but is expected by most to move to around $100, with Finbox predicting an increase to close to $110. Last, we'll look at the Fast Graphs forecasting calculator. If Chevron returns to its normal price to EBITDA share price of 8.34 from its current 7.09, and when considering the expected changes in earnings before interest, taxes, depreciation, and amortization between now and the end of 2023, we should expect around 21% annual returns including the dividend. Share price would hit around $159. By comparison, if Exxon returns to its normal price to EBITDA of around 7.81 from its current blended price to EBITDA of 7.98, we might see a 25.5% return with dividend included. Bear in mind, this assumes that there is no dividend cut, which may not be the case. In conclusion, between the two, I favor Chevron. I see less risk to Chevron in terms of safety and a potential dividend cut, and Chevron has a much better track record in terms of growth, dividend growth, and returns. Prior to the recent crisis, Chevron was outperforming Exxon, and I believe this could resume when the crisis is over. Over a 5-year time span, up until February 14th of 2020, Chevron was up 10.67%. For that same time span, Exxon was down almost 29%. Bear in mind, this is before the energy sector got hit hard. Although Exxon has been beaten down more than Chevron, and some might conclude that this makes it a better opportunity for a rebound, analyst expectations for the two in terms of future returns are actually fairly similar, with some analysts listed by Finbox and data provided by Fidelity seeing a higher return or growth rate for Chevron over Exxon. If I wanted to invest in a beaten down energy company with a huge yield and return potential, I would rather invest in Energy Transfer over Exxon, and I have a video explaining my thoughts on that as well. Now for Adriana's thoughts.
If you ask me, this competition is a complete tie. Yes, Exxon has a better PE ratio discount, way better profit margin, their revenue decreased less than Chevron's, but Chevron has a way better and way stronger balance sheet here. Also, way better free cash flow with less issuance debt. So for me, this competition is a tie and both companies are great investments. So it all depends on what you want to take into consideration before investing in a company, if their current valuation is the one that you want and with their stock price discount as well as their PE discount, or how the company manages their money. I do not see any of these companies disappearing or going bankrupt since they are the biggest one in the industry. What I do think is that the demand for oil will not get to what it was as soon as the economy reopens. I think it's going to be more of a gradual increase. Also, in the very, very long term, let's say 20 to 30 years from now, I do see a huge decrease in demand for the oil industry since the world is entering into the EV or electric vehicles world faster every year. Both are very secure investment because of the size of their companies, but I am not invested and will not start a position in any of these companies.
Thank you so much for watching. Please let us know which company you believe to be the superior investment and why. Where do you see potential in the energy sector? Share your thoughts in the comments below, and please subscribe to both our channels as we are creating new videos for you every week.
Hope you really enjoyed this video. Thank you and see you next time.